Spotlight, Nick Sleep, and Qais Zakaria, Nomad Partnership, a foundation of thinking. Hey everyone, it's been a little while. You'll have to excuse me again as my letters was typed on my struggling computer as I await a deal that makes sense on a new device. While avoiding, of course, all the scams, which looking for a good deal is often the case. Maybe, or hopefully, you find all the mistakes amusing while we keep the show on the road. Recently, I've been, for the better lack of a word, binging a lot of investment letters. Through this joyous process, I've been rereading many of them and finding that now that I've been managing my personal wealth for a few years, I'm getting a new perspective, especially as I grow as an investor and start asking myself bigger and bigger questions about those small things. Yes, as easy as it sounds, repetition is king and the best way to reinforce certain lessons. Anyway, the letters I decided to dissect in this instance are perhaps the ones that I gained the most from. My introduction to the Nomad Partnership was during my exploration of everything about Qais. I read his book and I really loved it, and at the time started devouring every interview and every guest appearance I could find. Around this time I also realized that I really liked this side of the world. From here he mentioned conclusions and ideas that the Nomad Partnership reached without mentioning them by name. Later interviews he does mention Nick and Zak by name. My next clue came a few years later from reading William Green's excellent book, Richer, Wiser, Happier, which has a whole chapter dedicated to Nick, where I get a lot more clues. Also, more snippets here and there from William's podcast, which you should definitely check out. It's fantastic. Anyway, after hearing those glorious mythical-like stories and also witnessing other bloggers raving about the amazing quality of letters that would rival the Buffett partnership, known as the actual benchmark, my curiosity got the better of me. Sometimes you really do need multiple things to hit you on the head before you take action, so oops. I found one of the unofficial circulating copies. Unfortunately, later discovered you can actually find the full letters on Nick's Sleep's foundational page. And please, if you do read them there. And dived right into them. The first dive was really a few years back, and this is actually the third time I'm going over these letters. First time I read the letters, I think I was too green to make much from their conclusions. Now, there was a waste of time or anything, it just wasn't ready, and it was closer to a mechanical exercise than an eye-opening experience. The second time I made some progress, but made another unfortunate mistake of trapping myself in a box and focusing only on the framework of analyzing businesses that the authors showcased. So as they sat, third strike and you're out, and again, I'm trying to fail in another cheesy joke, and you definitely have more strikes than that. But without regressing, this time, however, when I went with no expectation for myself and just to look what I could from the ride, I must say it was the best outcome. The letter led me on a journey of Socratic teaching that really led me rethink and reinforce many ideas. I know many things have already been stated and written about Nick and Zak. However, this is my reflection on what I took away, and it's a little payback in some shape or form. As Nick Sleep himself noted about the curse of coming last and the challenge of originally in the field of great minds. Of course, his quote is a little bit better. He said, when I finished writing these letters, I'm happy with them, at least happy enough to send them out. I make a habit of rereading them sometime later, and frequently they disappoint. It is if the letters have a short shelf life. I'm not sure they go downhill particularly, it's just that they do not start the high up the hill in the first place. The minds think they're better when they finish than they really are. Probably because we feel a self-imposed pressure to say something, especially something new or better impressive. Truth is that there's not much to say, at least not much that hasn't been said before. That's the curse of being 2,000 years younger than St. Paul, 44 years younger than Charlie Munger, and 29 years younger than my father. As always, disclaimers will be at the end. Perhaps given away by the name, the Nomad Partnership is unconventional, not just the way it's run, but also with the heads of the partnership. Nick Sleep actually comes from a geography educational background. I believe he has referenced The Art of the Motorcycle Maintenance by Robert Persing, which influenced his understanding of investing more than any financial textbook. After a university, it seems he worked as a landscape architect in department stores and in IT firms, and even as a professional sponsored windsurfer. So you might say not the typical investment hedge fund you would expect. In his mid-20s, he transitioned to an investment analyst at Sun Life, and in 1995, he moved to Marthon Asset Management in London. And after lobbying his bosses for over 6 years, in 2001, he and his partner, Zak, started the Nomad Partnership. His partner, Zak, was born in Iraq. This was around the late 1969, I think. And after a political outage, his family fled to the UK in the 1970s. His father rebuilt his family through a successful business supplying machinery to Iraq, but unfortunately he later went bankrupt due to speculative stock market bets and pyramid schemes. So you can guess, not the easiest upbringing. Zak grew up dreaming of becoming a meteorologist, but pursued mathematics at Cambridge. Upon graduating, Zak took a job as an analyst in Hong Kong at Jordan Fleming. Then in his 20s, became a sell-side analyst for Deutsche Bank for the Asian equities. During the 1997 Asian financial crisis, he scavenged for undervalued stocks, investing $500 million through collaborations, and profited from the rebound. From my understanding, during his role, he developed a relationship with Nick and joined him to form Nomad. Over the 13-year run from 2001 to 2014, the partnership gained a cumulative return of 921.1% compared to the MSCI World Index of 116.9. That's a tenfold increase in investors' capital. Investing $1 would have grown to approximately 1021 versus 2.17 for the index. If you're wondering, for the S&P 500 for over a similar period, from September 2001 to December 2013, with dividends reinvested, $1 would have become a gross sum of $2.18. So quite an unbelievable accomplishment. Fun philosophy. Right from the get-go, the Nomad partnership was unconventional compared from the typical hedge fund. They were built much like the Buffett partnership, focusing on earning with their performance over the typical 2 and 20 hedge fund structure. Furthermore, Nick and Zak would actually refund fees at times. Their goal was to structure the fund in such a way that the fee of running the partnership became fixed and the partners won in the economics as it grew. Definitely, many firms can learn a thing or two from this. They really believed in their famous developed shared economics of scale model, a business model built on the idea that as your scale grows, you can bring costs down and in turn offer customers lower prices, perpetuating a cycle. Famous examples are Costco, with set profit margins, or Amazon. Basis says your margins are my opportunity. I must say, Nick Zak has an excellent write-up on Costco, so if you ever want to work on investments, you should definitely read it. Therefore, Nick and Zak would bring what they learned about the model and run their business the exact same way, lowering the fees as much as they could to benefit their partners. Anyway, I'm starting to ramble on about their fee structure. The actual fun and why the letters are so famous is actually because there is a clear evolution of thinking in their... because there's a clear evolution of thinking in the progression of the letters, and the type of securities that are held change. The fund was always concentrated in fund to avoid Peter Lynch's famous diversification trap. They started with 18 positions, but as they became more confident, betting heavily, and understanding their businesses, the fund closed with just 3 positions: Costco, Amazon, and Berkshire Hathaway. Not only was this concentration unique, but Nick and Zak really believed in working where their advantage was. They believed they could look in not-so-popular places and find ideas that they don't make sense. Of course, that's how they started. As we said, they evolved. You know how cheap they were, by the way. They invested in Thai concrete companies, coaching bus companies. They learned a lot selling this great, hard-fought lessons of mission, newspapers, and more. They also really focused on where they had the advantage. Nick and Zak believed they were playing the game at the end zones, one where they were not actually competing against the whole market, but only those focused on the long-term tail of their returns. So the people competing at the short end were playing a harder, more competitive game. Here's an extra of 2 quotes that kind of demonstrate that. One of Nomad's key advantages will be the aggression patience of its investor base. We are generally investing for the long term. Few are. In modest valuation firms run by management firms who are making decisions the fruit of which they may be apparent for several years to come. Good investing is a minority sport, which means that in order to earn returns better than everybody else, we need to be doing things different than the crowd. And one of the things the crowd is not is patient. To back up all these principles and ideas, Nick, and I'm sure Zak too, had a very strong background and deep internal understanding of the psychological factors. Just like Munger's famous speech, Nick also gave one focusing on more psychological factors and biases affecting him. I would strongly recommend everybody to read it. Of course, Nick admitted that it's hard being after all these great minds like Munger. It makes all his conclusions seem what somebody already said. The other principle that led to really understanding their positions in their notion of holding a position requiring a daily decision not to sell the shares as well. They believe these decisions coupled with, whilst we may only write twice a year, we often share for such long periods. If the current rate of portfolio activity should persist, that we write around 20 letters during the lifetime of an average investment. That's a huge amount. Gives Nomad a huge edge over other managers. So some of my takeaways. feel like I'm repeating myself, but as we're studying other managers, there are many things to take away. I will try to limit myself to a few ideas that really stood out and made me think. Primary thing that really stood out, and not only because I've spent the last 60 months pondering many of these ideas, is the perception of index funds. I think if we analyze from today's standpoint, especially from the viewpoint where index funds have averaged 16.17%, which have reinvested, okay, of course, data will vary depending what you did, but anyways, over the last 5 years, and keeping in mind that our memories are often short, investors have really become like moths to a flame, forgetting what is it they are buying, and that it is not a riskless asset. Returns, for example, for the 90s was 17.6%, for the 2000s was negative 0.9%, and for the 2010s we averaged 13.6%. Anyway, the Nomad let us iterate time and time again that they are not focused on the index. So there's no confusion. The index is not our benchmark. Zach and I spend no time at all thinking about the index. Indeed, we are unaware of the index returns until I set about writing this letter. And its inclusion at the top of the letter reflects the genesis of the index-related investment firm more than our orientation. If we started Nomad again today, I'm not sure we would present the results this way. But be that as it may be, we will leave the index at the top of the letter for now. As for some partners, they may be helpful in placing our results in context. They have plenty of cheeky comments of, I'm afraid in 2006 you would have done better buying an index fund, if only you knew which to buy in advance. Nick also emphasized that the most common mistake is the view index as a risk-free home. And I think it is a very important point that many today, especially young investors and markets, are pushing the idea that the index is risk-free and are put money and forget about it. But the index is not something magical. It's a basket of assets, some overweight in certain assets, that will perform like the underlying assets. There could be market mania, but you will still own these assets over the long term. Yes, small rant there, but what I took away from Nick and Zak is not to emphasize the index so much, but focusing on it psychologically orientate yourself to work around the index, and that has its own downfalls. We're looking down the road less traveled when we argue that the index is not risk-free. It is one of many opportunity sets. This year that opportunity sets beat us, and it may do so again next year, and year after that. We should all be prepared for the possibility of static of its occurrence next sleep. The other big takeaway stems from how to think about opening and closing funds and their appropriate sizes. As an aspiring fund manager, I have spent time thinking about the whole notion of how and when to let peer partners in. What do I mean? The whole investment industry is built on around maximizing AUM. AUM is just money under management. Because the higher the AUM, the larger in dollar terms the fees you can collect. The fund manager is very much incentivized to continue building the business. But even when you limit the size, there are times when you need capital flows to acquire high conviction ideas, especially during troubled times. Nick and Zach's influence is really focusing on the ethics of opening your fund and how it affects overall returns. Honestly, before reading Nomad letters, for the first time in a couple years back, a lot of these questions never crossed my mind. Because at times, even when you're growing your business and open to new opportunities, you could be inadvertently hurting partners. For instance, imagine you're identified a compelling opportunity to deploy 20% of your fund's existing capital to buy in at an attractive price, say a stock trading at 50 cents on the dollar. If you open the fund to a new investment right now, the fresh money dilutes the position overall in the portfolio for your original investors, potentially reducing their proportional upsides as the assets appreciate. Even if the new capital is invested in the same idea, it might push up the purchase price slightly due to your own buying pressure, or worse, force you to hold excess cash if no other high conviction ideas are available, dragging down overall returns through opportunity costs and inflationary erosion. Another example hits home when considering a small fund's growth trajectory. Suppose you start with the modest AUM and spot a gem, investing $20 million in a steep discount. Over the next few years, that position doubles to value $40 million, which sounds great on paper, but if during the same period you've aggressively accepted new subscriptions, growing the fund, say, $100 million to $500 million, the original investments now represents a much smaller piece of the pie, from 20% of your fund to 8%, and the total fund return gets watered down because the bulk of the new assets might be deployed in less exceptional opportunities, or simply lag behind. This not only mutes the compounding effect for early partners, but raises real ethical questions about fairness. Are you prioritizing assets gathering over stewardship, especially punishing the contrarians who backed you up by spreading the reward thinner? Nick and Zach's approach in the Nomad letters really opens my eyes to mitigating this. They emphasize closing the fund by default, reopening only during market dislocations where bargains are bound, like during the 2008-2009 financial crisis, and using right issues to give existing partners first dibs on new capital raises. Of course, I promise to keep the source to the last idea I'll give very briefly. Nick and Zak really emphasize the importance of making the decisions not to do anything. Inactivity, except perhaps for the observation seldom made by the decision not to do something, is still an active decision. It is just the accountants don't capture it. They really drilled it down throughout the letter. You can see how brief we can make it. What I'm politely stealing. I have now read many different fund partners' letters. Some were a festival of self-promotion and filled with nothing but bragging statements. I'm not sure if that's the correct way of saying it. Others were filled with cliché ideas, and some seemed to be written to convince themselves more than anyone else. The Nomad partners' letters are completely on the opposite end of the spectrum. They are a masterpiece of legendary piece of writing. When I first read them, they could rival the Buffett partnership letters. I couldn't quite believe it. But now, at least for me, they're a better piece and have influenced me far more. What I would love to emulate from Nick is just the beautiful writing style he has. It's engaging, funny. I found myself laughing or writing lol, good joke, a bunch on my notes, and super informative, as well as really makes you ponder and think. If I could even emulate 10% of this skill, my letters will improve by leaps and bounds. Alas, this will come with probably experience. What else I would like to steal is the full commitment Nick and Zak had towards their business. They ran the partnership exactly how they believed the business should be run. They ran on their own way to make the life better for their partners. I really hope I'm strong enough to make my partners sprout the following example. Conclusions. Well, friends, I hope you enjoyed my rambling. I do think even with the growth of reputation and fame the Nomad partnership have gotten over the years, it's still an underrated piece of educational material. The letters themselves are a gift to humanity. Thank you, Nick and Zak, for your wonderful work at Nomad, for all these insights you directly shared with me and hundreds of investors worldwide. As you stated, I think they achieved your goal of pushing the investment framework just one step beyond where they started. Personally, I think many steps, but I can't speak for everyone. Letters are by far the top 3 investment materials I've ever read, and I will continue to make attempts to reread them over the next couple decades. I think many will learn from even briefly skimming this great piece of history. Also, I think special thanks to Martin Klarsky, sorry if I'm mispronouncing your name, for compiling a Kindle version of this letter. I tried to find it again online, but it seems to be down, but you can definitely connect with him on LinkedIn. Also a little, but congrats on his amazing website. As I mentioned, it's the 3rd time I read this partnership letter. This time rereading it on my Kindle with digital highlights and notes made it very easy and revived the profound ideas that made me think, as well as compiling them into a nice fancy document. I will end this letter as much in the way that Nick Sleep did. In his December 31st, 2008 letter, Nick Sleep introduced the story of the Ferrari's first wind tunnel design car, the 250 GTO. I don't have quite the storytelling ability Nick has, so here's a little snippet. Let me finish with a story by the radio presenter and a car collector, Chris Evans, that has parallels to the stock market bargains today and helps demonstrate the merits of doing some proprietary work, sniffing around a great investment and holding forever. First, a little background. In the late 1950s, Ferrari motor cars successfully competed and won almost all major GTO class races of the time. But by the early 1960s, they had started to lose grounds and the slippery shaped Aston Martin and the AC Cobra, amongst others. The solution was Ferrari's first wind tunnel design car, the 250 GTO, which was launched in 1962. It was instant success and beautiful to boot. The 250 GTO owner Paul Vesti recalls childhood memories of seeing 5 GTOs lined up in the start of the Greenwood TT in Sussex, England, and immediately all the other cars looked ancient. Instantly, we all wanted one. The car won almost everything, going and becoming an immediate classic. It was also quite rare. 100 cars would have been built to qualify the vehicle for the GTO class racing rig, but in the end, only 36 were actually produced. The effect today is that 50 and 60-year-olds looking to buy their boyhood dream car may have to pay world record prices. Think 10 to 50 million. The next time one sells an auction, and some successful season of the GTO was replaced with the faster models, and during the mid-1960s, Ferrari sold off its racing vehicles to enthusiasts. At this time, the third James Bond film, Goldfinger, was launched, which featured the now iconic Aston Martin DB5. Back to Evan's story. 155, in the mid-1960s, a very famous collector who has one of the finest noses of sniffing out a deal hears a whisper of the first James Bond Aston Martin DB5 may be for sale. The world is at the right money. The original James Bond car can be bought directly from the movie studio. So he makes a few calls, he tracks down the producer guys. It's going to have to be 15 for the pair. You mean there are 2? Hey man, this is show business. There's always two, at least. But 15 for the pair? Says our man. I wasn't counting on spending that much and I didn't really want to. I just want one. Well, here's a tier. Take it or leave it. £15,000, a lot of money now, and a lot of money then. Our hero hesitates for a moment, but his nose knows better. Tells him to deal. He buys the car. The car is to be paid on delivery on both vehicles. The day arrives. The trailer pulls up. The car rolls out. The invoice reads £1,500. Yes, friends, both original Bond cars for £1,500. But it does not end there. Be prepared to run for the hills screaming. Our man then swaps the Bond's car for a GTO. That GTO for £750. That's the cheapest GTO ever, and he still has it today. So for a minute, let's assume they acquired the amazing vehicle on January 1st, 1965 for £750, about $2,093. The most recent sale I found was in November 2023, when a 1962 Ferrari 330 LM 250 GTO sold for $51.7 million at RM's Sotheby's auction in New York. That would mean his investment returned a total of, $2,470,038.56% with an annualized compounded rate of return of 18.75%. For comparison, equivalent investment in the S&P 500 with dividends reinvestment over the same period would have yielded a total return of 27,465.69 with an annualized return of 10.02. Additionally, there was a higher sale of GTO 250 that was sold in 2018 for $70.2 million. However, it was that the car actually raced, and therefore so that car actually raced and won, so I kind of discarded it, but if you do count it, it would have yielded a total return of 3,353,937% total, so till 2018, with an annualized compound rate of 21.54%. Again, for comparison, equivalent investment in S&P during that time period would have yielded you 15,644.20 with the annualized return of 9.93. So 21.54 versus 9.93. So perhaps some food for thought, and I hope you enjoy this letter, and we'll be ready for more to come. Cheers, Daniel. P.S. Nick noted that one of his letters that it can be tempting to think that more money is the answer to problems, but it strikes us it is not the money you have, but the choices you make that count. As always, I'm saying this should be not should be construed or thought of as investment advice. The content is entertainment purposes only. Please consult your financial advisor for personalized advice before acting on any information you read. The author may hold positions or in the future hold positions in the securities discussed below. Thank you for listening to 18 Degree Partnership Tunes.